Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In the previous video, we looked at how technical analysis and trading generally is faced with the challenge of skew decay because over time the market change. The market is dynamic in nature, and if a trader is not constantly learning and upgrading his trading skill, then without without doubt over time that trader becomes obsolete. In this video, we want to look at market seasons and cycle and how they can influence market directions and movement. Generally speaking, there are two main seasons in every market, which is the bull and the bear season. And the bull market or the bull season basically is a period, it's an extended period in the market where the prices of everything literally goes up. This season is represented by a bull, uh, which basically strikes with its own thrusting forward, which is raising something up, while the bear market on the other hand is a period in the market where the prices of financial assets literally just goes down over an extended period of time. These are the two basic market seasons that we have. Regardless of whether it is the bull or bear market seasons and cycle can be divided into four phases, which basically looks at how money flows in a market cycle. These phases are the accumulation phase, the markup phase or expansion phase, distribution phase, and then the contraction phase. We'll look at each of these quickly. First, we have the accumulation phase, and basically, the accumulation phase is that period in time where market participants basically accumulate a particular financial asset, and this can be seen on the price charts by sideways price action. On your price chart, you can identify areas where these accumulations are going on, because you would notice that prices are not trending in a clear direction. Prices are not going purely bullish or purely bearish. You have prices moving in a sideways direction before an impulsive move to either the upside or the downside. So basically, in the accumulation phase, prices move sideways, and this is where smart money and institutional investors and traders basically are looking to accumulate and buy valuable assets. Next, we have the markup or expansion phase, and the markup or expansion phase is that period where you have prices moving aggressively in one direction after a prolonged sideways movement. So basically, what happens is you have the accumulation phase where smart money and intelligent and institutional investors basically were accumulating a particular financial asset, and then as the price of that asset begins to break out of that accumulation range, what happens is retail traders and investors begin to jump in. So institutions and smart money goes in first in the accumulation phase, and then as prices begin to move out of that phase, retail begins to jump into the trend in an attempt to catch the trend in order not to miss the move. So that phase where you have prices moving aggressively because of increased retail activities, because of increased influx of retail activities into the market, is where it's considered to be the expansion or markup phase. The distribution phase, on the other hand, refers to that prolonged sideways price action that happens after an aggressive move to one side, an aggressive move to the upside or to the downside. What basically happens in this phase is institutions, or either institutional money or dump money, market participants basically look to pick up a particular financial asset with the aim being mainly to sell in an attempt to make profit. So in the distribution phase, Smart money, and by smart money I mean intelligent investors and traders, are basically looking to offload their bags of assets, of either stocks or whatever financial asset that they have picked up earlier in this phase. It is usually followed by the markdown or contraction phase, which is usually that period where, after institutional and smart money have sold off in the distribution phase, where retail begin to identify this selling of activities and starts to jump into panic sell. So guys, these are basically the four market cycles that we have, regardless of whether it is in a bull market or it is a bearish market. It is very important to understand this four market, because you don't want to be buying where the most of market participants are looking to sell, as well as you don't want to be selling